back to the channel, everyone. On today's video, we're going to be talking about Canoe EIT Income Fund. It's ticker EIT.UN on the Toronto Stock Exchange. It pays a very generous yield of 9.08% and it's paid out monthly. I know a lot of you income investors love that type of thing. It's at a 52-week high today. It's just $13.20 per unit and it pays 10% monthly distribution, okay? So this is a great alternative to a high interest savings account. I don't know how many people tell me they have their money in a high interest savings account getting less than 1% yield. You're throwing your money away because inflation is going to eat it all away. How many articles have you seen recently on Google News saying that inflation's running 5% plus this year? Okay, so if you have your money earning 1% a year in a high interest savings account, you are losing buying power at an enormous rate. If you have your money in an alternative investment such as Canoe Income Fund and you're getting 9%, well, 5% inflation doesn't bother you because you're getting that plus a little bit on top, okay? So it's just an alternative investment. We're going to look at it today. We've covered other covered call ETFs on this channel, QYLD, ZWC, and ZWB. This one pays a super generous yield, and that's why we're talking about it today. First, I want to talk about the management expense ratio. Okay, you'll see here it's listed at 1%. This is very high for a regular ETF, but you have to remember this is a covered call ETF. The fund managers are actively managing this. They're setting the calls. The prices need to be exact for this fund to make money and continue to produce gains for you all the time. So they need to be making a little bit more. So 1% fee. It is high for a normal ETF, but it's in line with covered call ETF. So keep it in mind. And if you compare it to a regular, mutual fund that has a 2.5–3% fee, you're really ahead of the game on this one. On the screen here, you're going to see the equity sector allocation. We can see how this ETF is divided up into different sections, the biggest being financial. That's why we're getting that huge yield. Well, part of the reason, we'll get into that. Energy, healthcare, materials, industrials, and then we're getting pretty low at 4% down to 1% with consumer staples, services, discretionary real estate, and information technology. These aren't big parts of the fund, but they are there nonetheless. Now let's take a look at the top holdings. Toromine Oil Corp, that's a really popular one right now. Bank of Nova Scotia, RBC, you guys know I love those ones. Intact Financial, we get a little bit of insurance in there. CVS, Berkshire Hathaway. You've heard of all these companies. They're big, they're household names, they're safe. If we look at the asset allocation by country, the most of it is Canadian equity at 52% and 36% American, and the rest is pretty small. We won't get into that. So the fund managers are making your 9% yield by taking the dividends from these companies. And in addition to that, they're putting the covered call option. So they're writing, buying and selling all the time. That's where you get your 9% yield from, just so you guys know. Now, a major criticism of covered call ETFs are what they do to your initial investment. Over time, the criticism is that it goes down because it's hard to keep up with such a high yield. The price just goes down over time. We're going to take a look at the growth of $10,000 invested on this chart here that Canoe has provided us. This is a one-year chart. If we invested $10,000 over the year, we'd have $16,000 now. So over this one-year time period, traditionally the fund going down, that's not correct, okay? So we're going to look at a 3-year time period. Let's see if that holds true. No? $10,000 still would be $16,000 in 3 years, okay? So you're not getting a huge growth over a 3-year time, but it's still a lot of money. You're still doing well. How about 5 years? You're still making money. It's almost $18,000. Wow, maybe this fund's better than most. Let's look at 10 years. $10,000 in 2012 is now worth $25,000. Now, this chart does include dividends being reinvested into the fund. So that's an important thing to keep in mind, guys. And since inception, this fund has done absolutely great if you keep investing the distributions back into it. $10,000 since inception, which looks like it's maybe 1998 or 1999, is worth $82,000 today. So that's pretty significant gains. Not as much as if you would have invested into individual growth companies like Microsoft or Apple, but for income-seeking investors, this fund's done really well. It's done great, to be honest with you. Canoe also has a performance review of the ETI fund versus the S&P index, and I think that's a popular benchmark to compare it to. So let's just quickly take a look here. Year to date, EIT wins. 1 month, tied. 3 months, S&P barely squeaks it out. 6 months, EIT wins. 1 year, EIT wins. 3-year, EIT wins. Well, we're seeing a trend here, guys. 5-year, 10-year, since inception, EIT.UN has beat the TSX Composite Index since it's the fund's inception. That is absolutely remarkable, guys. I think this might be the absolute best performing covered call ETF, or it's the best performing that I've ever heard of. Let me know if you guys know of a better one, because it's blowing me away how well this fund has done. Anyways, I'm still investing in more growth companies right now, but when it's time for me to change into some covered call ETFs, this is going to be the absolute first one that I buy. I'm really excited. I'm really liking this one. Let me know if you guys own it or plan on buying it in the future. Thanks for watching, guys. Like, subscribe, all that good stuff, and we'll see you in the next video.